I think, I mean, with respect to gold, I mean, you can say it's front running the situation. Okay, I wouldn't disagree with that. But what's the participation? People aren't buying it in the West. I mean, you got something like, $300 trillion worth of portfolios. What do they own? 0.5%, probably. I mean, it's basically what's been driving gold are the central bankers who can see exactly what I've been talking about, getting the hell out of dollars, getting the hell out of euros, and getting the hell out of sterling. That's actually what's been driving it. The central bankers, the guys who really know, right at the top, if you like, they're the ones who've been getting out of fiat currencies into gold, and that's why gold is, knocking on $3,700. It's got nothing to do with the investment community. They're sitting there, as I say, like a rabbit at the road, frozen by the headlights of an oncoming car. Basically, they can't really fund out along the yield curve because the auctions are disappointing. And I think that's going to get worse if they try it. So it's increasingly going to be T-bills. And this is why the Fed has been looking at reducing the supplementary leverage ratio on large banks. That will create balance sheet space for banks to buy treasuries. And they're not going to go out along the yield curve. They will buy short term. I mean, I can see the logic of, trying to get some breathing space by reducing the Fed funds rate, to which, for example, 3-month and 6-month T-bill rates are effectively tied. So I wouldn't rule out a 0.5-point cut. I don't expect a 0.5-point cut. And I suspect also that in terms of precious metals, if you get a 0.5-point cut, gold would probably go through the roof. Get a 1/4-point cut, you might get some profit taking. So I think, that's something which we can just dismiss as a short-term effect. It's not going to change anything. And what we've seen really with the dip in bond yields recently, I think, is just a pause before the move. Before the move goes far higher. I mean, you and I have been in markets long enough to know that very often the first move is in the wrong direction, and it's followed. Then followed by the way the underlying direction is really going. And I think we'll probably see that also in bonds. I mean, we've seen bond yields fall. And of course, this is a catastrophe for France. It's a catastrophe for the UK as well. And I think that the problem with deferring the autumn statement, budget, whatever you like to call it, until the end of November, is that it actually gives more time for a crisis to happen before the Chancellor actually stands up and delivers her statement. I really do think this is a hell of a mess. I mean, it's going to turn out to be a real mess, this one.
With yields rising, speculation grows around the Fed's next move. A 0.5-point rate cut would ease short-term funding costs, but risks inflaming gold prices, potentially triggering a surge past record highs. Even smaller cuts could spark temporary volatility, but they don't alter the long-term trajectory of debt markets. Bond yields may dip briefly, but structural pressures point higher. For precious metals, especially gold, Fed actions serve as short-term catalysts layered on top of a deeper story. Central banks diversifying away from dollars. Each shift in Fed policy adds fuel to a fire already smoldering beneath global finance.
You're transferring confidence in the government to, or lack of confidence in the government to lack of confidence in the currency, I think. I mean, there isn't actually a way out of this. That is the problem. In the past, markets have given the authorities an awful lot of, if you like, slack in terms of being able to do things which economically are destructive. I think that's not how, I think we've come to the end of that road. I mean, one of the things that's really going to kill the dollar, I think, in 2026 is, the developments we've seen recently with BRICS. I mean, it's fascinating. Apparently, Modi in India turned down. I mean, he refused to answer the telephone 4 times to President Trump when President Trump realized that he'd made a huge great mistake trying to sanction India for taking in and processing Russian oil. I mean, this was the art of the deal. But I mean, the art of the deal really depends on your interlocutor actually talking to you. And Modi said, no, forget it. And next week, he was in Beijing, or not, but Tianjin, or whatever it was, the SCO conference, hugging and kissing with Putin and Xi. That said it all. I mean, these are the 2 most populous nations, India and China, 2.8 billion people out of a total population on the planet of about 7.5 billion. I mean, what we're looking at, I mean, you were saying that, sort of BRICS and SCO, we're looking at something like 40%. If you look at GDP in purchasing power parity terms, China is already a good 30% larger than the United States.
Across the Atlantic, Europe faces its own crisis. Bond yields in France and the UK have begun flashing red warning lights. Delays in budget announcements add uncertainty, while political divisions make credible fiscal plans harder to deliver. Confidence in governments quickly spills into confidence in currencies, leaving the euro and the pound vulnerable. Europe's structural weaknesses, sluggish growth, high debt, and fragmented leadership in Brussels compound the risks. Some nations like Italy and Hungary are adapting, attracting capital and talent. But the Eurozone as a whole looks increasingly unstable, setting the stage for deeper financial fractures in the years ahead.
Taking the whole thing, I mean, what we're seeing is China is tying up the majority of the world economy as its own market. It no longer cares about America. It no longer cares about Europe. I mean, we can ban them from here to hell and gone. It's not going to change anything. And the one piece in the jigsaw which is yet to really be put in place is the one which we can now see developing, and that is a yuan which doesn't share the fate of the dollar, the euro, sterling, and the yen. The yuan will go on a back. I mean, the way it's going, you can see quite clearly that they're modeling a new gold-backed currency based on the way in which Bretton Woods worked. In other words, it won't be for individuals, if you like, to exchange yuan for gold. It'll be at the government level, and it'll be international trade related. Exactly what we had under the Bretton Woods system. This is Bretton Woods Mark II. You can see it. It's there. Now, what does that do to the dollar? It kills it. Because you got the majority of the world, both in terms of population and GDP, no longer needing the dollar. And so, you've got $40 trillion of financial assets. You have got, according to the Bank of International Settlements, a further 80 trillion tied up, if you like, as part of the foreign exchange markets. On top of that, you've got the euro-dollar market, in other words, offshore dollars, which are a further 10 trillion. So you've got what? About $130 trillion seeking a home. Where does it go? It goes back to America, doesn't it? It gets sold. It's redundant. That's going to collapse the dollar. You collapse the dollar, what do you do to us? You collapse us as well. And the Eurozone, God bless them. And also the yen. I mean, this is the challenge. Dealing with this is the challenge in 2026. And markets are blissfully unaware of it. I mean, they're still, momentum chasing Nvidia and Bitcoin and all the rest of it. I mean, it's crazy. People are asleep. Wake up.
The rise of BRICS nations signals a major shift in the global order. India and China, home to nearly 3 billion people, are strengthening ties with Russia, creating a powerful economic bloc that no longer orbits around Washington. Trade between BRICS members is increasingly conducted outside the dollar system. Meanwhile, discussions of a gold-linked settlement mechanism, reminiscent of Bretton Woods, are gaining traction. If a yuan-backed trade currency emerges, the dollar's role as the world's reserve anchor will erode rapidly. With over 130 trillion tied up in global dollar-denominated assets, this transformation could spark unprecedented volatility across financial markets.
I think, I mean, with respect to gold, I mean, you can say it's front running the situation. Okay, I wouldn't disagree with that. But what's the participation? People aren't buying it in the West. I mean, you got something like, I don't know, $300 trillion worth of portfolios. What do they own? 0.5%, probably. I mean, it's basically what's been driving gold are the central bankers who can see exactly what I've been talking about, getting the hell out of dollars, getting the hell out of euros, and getting the hell out of sterling. That's actually what's been driving it. The central bankers, the guys who really know, right at the top, if you like, they're the ones who've been getting out of fiat currencies into gold, and that's why gold is, knocking on $3,700. It's got nothing to do with the investment community. They're sitting there, as I say, like a rabbit at the road, frozen by the headlights of an oncoming car.
Gold's relentless climb is not driven by Western investors, but by central banks. Quietly, they've been unloading dollars, euros, and pounds, shifting into bullion as protection against monetary instability. This explains why gold continues to push higher even without broad retail enthusiasm. Western portfolios, worth hundreds of trillions, remain heavily skewed toward fiat assets earning minimal returns. In contrast, policymakers and emerging economies are hedging against a weakening dollar system. At current trajectories, gold could evolve from an alternative asset into the backbone of a new monetary framework, signaling a tectonic change in global wealth preservation strategies.
I mean, the fact is, the way the world is going, it's going China's way.
It is.
I would not claim that the Chinese are popular with local Africans. They never have been. But their approach actually has accommodated that. I don't mean accommodating it by, suddenly making them terribly popular with tribal Africans, but they do understand this. And the point is that the investment that they do in African countries is productive. That is the key point. What we've done is we've just basically chucked money at the politicians on the basis you stay on our side, otherwise the money stops flowing, or we'll arrange regime change, whatever. I mean, we're not talking, they're not nice people, the Chinese government. Don't get us wrong on that one. No government is nice. But, the fact of the matter is that they now dominate the world, along with Russia. They have got control over the world. America, particularly under Trump, has lost its hegemony completely. Trump has destroyed it, with his MAGA. I mean, what does that mean? It means he's been autarkic. He's sort of coming in. America's coming in on itself and cutting off its trade relations with everybody else because it wants to start making its own stuff. I mean, that's actually the reality of it. The Trump administration has actually hastened the decline of America. And the interesting thing is that it would appear that the deep state in America is now focusing on controlling the Americas rather than the rest of the world. That I find is an interesting development. It seems to me that that's a recognition in the deep state that they've lost this one.
The geopolitical map is redrawn before our eyes. China and Russia are consolidating influence across Africa, offering infrastructure and investment where the West once imposed conditional aid. The U.S., increasingly inward-focused, risks ceding global leadership as its debt burdens and political divisions mount. Europe teeters between cohesion and fragmentation, while Asia forges a new financial and trade axis. What emerges is not simply a decline of the dollar, but a broader unraveling of the fiat currency system. The coming years may mark the end of monetary dominance as we've known it, and the dawn of a multipolar economic era.
I think things happen in phases. I mean, the first thing we're seeing is a decline of the dollar. And that will have the knock-on effect on all the fiat currencies, because really what we're looking at is the end of the fiat currency system. I think, I think that Europe is in great risk of falling apart. The Brussels administration is a joke. and it hasn't really got control over anything. I mean, not democratic control. So long as Brussels exists, it is divisive, I think, between nations rather than cohesive, which it's meant to be. You can already see that there are some factions which look more likely to survive than others. And I would say that Italy, under Meloni's really, I mean, that is a recovering well. And she's also got the common sense to realize that you've got to have people with wealth around you rather than chasing them away. I mean, you get the head of Goldman Sachs Europe moving to Milan, for goodness sake. I mean, that was a huge signal, I think. And also Hungary, and some of the Balkans, etc. So I think there's, there is a sort of, if you like, a left-right, a sort of welfare state is history part, and welfare state, we're going to continue on down that road because we're communists after all, like France, Spain now. Germany is difficult. Germany is a mess, a huge, great mess. You've got the politics of anti-Russian politics and all the rest of it, and I think that's probably going to go to an extent. But I think Europe's sort of dividing into those sort of two camps, and I think it'll just break apart the whole thing. The euro itself is, it's like a camel, put together by a committee. It won't survive. Of that, I'm absolutely sure.